If you are an Indian investor looking to make smart moves with your money, you have probably heard about ELSS or equity linked savings schemes and PPF or Public Provident Fund. Now both of these let you invest up to 1.5 lakh rupees and take advantage of tax benefits under Section 80C. But here's the deal. A lot of people invest in PPF even though ELSS is the better option. In today's video, I will share solid reasons why ELSS might be the better pick for maximizing your tax savings and building wealth for the future. My name is Kanak and welcome back to my channel. Your support is what keeps this channel running, and if you find this video helpful, then show your support by liking and subscribing to the channel. Before we begin, for the viewers who are new to investing, ELSS or equity linked savings schemes are a set of mutual funds that you can invest in and claim up to 1.5 lakh rupees in tax deduction each year under Section 80C. Whereas PPF or Public Provident Fund are similar to fixed deposits with a lock-in period of 15 years offered by the Indian government, which again you can claim up to 1.5 lakh rupees in tax deduction each year under Section 80C. Now let's talk about why choosing ELSS over PPF is a smart move for your money. The main reason here is long-term returns. If we check out the returns from ELSS in the last 3, 5 or 10 years, they have been above 15%. Now compare that to PPF. Its interest rate over the last 20 years has been around 7 to 9%, averaging at about 8%. Now the whole point of investing is to beat inflation. Imagine if your returns are less than inflation. Your money's purchasing power does not really grow. Looking at inflation rate in India over the last 2 decades, it has been bouncing between 4 and 10% and averaging at around 6%. So when you put your money in PPF, you are only getting 2% real returns above inflation. That means your money's purchasing power grows by a mere 2% each year. On the flip side, with ELSS, you're looking at real returns of more than 8%. To put it simply, investing in PPF barely keeps you up with the inflation. But putting your money in ELSS puts you way ahead of inflation, actually building wealth for your future. Now you might be thinking about the risk of investing in ELSS. Yes, there is a chance that the prices might take a little dip in the short term. But here's the deal. If you stick around with ELSS for long term, like 3, 5 or 10 years, chances are you'll outperform the returns of PPF by a big margin. Now remember, India is the fastest growing economy and the Indian stock market has been giving a solid 15% return over the last 30 years. So putting your money in the Indian stock market through ELSS for the long run is a more profitable move. Now here's the reason number 2 why ELSS is better than PPF. PPF puts you in a 15-year lock-in period, but ELSS just 3 years. With PPF, you can only partially withdraw your cash after 6 years. But ELSS lets you pull out the whole 1.5 lakh rupees just after 3 years. Life is always uncertain and waiting 15 years for your money might not be the most convenient thing to do. Now here is some very important and interesting information. If you sell your ELSS investment after 3 years, you can throw that same money back into ELSS for tax savings in your 4th year. You don't need to invest new cash. Just invest 1.5 lakh rupees in ELSS each year for 3 years. Then keep that same money rolling to keep getting those tax benefits. Now let us talk about taxes. With PPF, there are no taxes on gains. But even though ELSS has a capital gains tax of 10%, the taxes on gains up to 1 lakh rupees are zero. Imagine you invest 1.5 lakh rupees in ELSS and it grows to 2.5 lakh rupees in 3 years. Well, you can take out the whole 2.5 lakh rupees without paying any taxes because your capital gains was only 1 lakh rupees. Now let's do some simple math. The Indian stock market's long-term rate of return has been about 15%. So at a 15% historical rate of return, your 1.5 lakh rupees will turn into 2.3 lakh rupees at the end of 3-year lock-in period. This 2.3 lakh rupees is still below the taxable limit of ELSS. So in simple terms, because your gains were under 1 lakh rupees, you will incur no taxes on your ELSS money. So let us summarize why ELSS is better than PPF. First off, ELSS gives you returns that beat inflation by a whopping 8%, while PPF is at trailing 2%. Next up, ELSS has only a 3-year lock-in period, and after 3 years, you can reinvest the same money in ELSS for the same tax benefits. PPF, on the other hand, puts you in a 15-year lock-in period, with partial withdrawal only after 6 years. Lastly, even though ELSS has a 10% tax on gains, the first 1 lakh rupees of your gains are tax-free. So chances are pretty low that you will end up paying taxes on your ELSS gains.